The tectonic plates beneath the economic landscape are shifting, and the rumblings are being felt across global markets. A new era is upon us, one where the long-prevailing assumptions about permanently low interest rates and feeble growth may be upended. The investing class is signaling a crucial transition, a great reordering where the rules of the game are being rewritten. For over a decade, the financiers residing in the glass towers of Lower Manhattan operated under the gospel that rock-bottom rates were the new normal. Central bank money printers were the high priests, leveraging unprecedented monetary policy to resuscitate economies battered by the Great Recession. Yields were mercilessly repressed, inflating asset bubbles in the name of spurring lending and spending. An entire generation of investors became inured to this artificial, low-rate wonderland. But now the heresy is emerging. Investors are betting that interest rates will remain significantly elevated even after the Federal Reserve's latest hiking cycle runs its course. No longer are they pricing in a return to the pre-pandemic equilibrium. Instead, the markets are engaging in a collective act of revisionism, reassessing long-held assumptions about economic potential. The numbers tell the tale. Federal funds futures markets point to the Fed's benchmark rate settling around 3.6% from 2027 onward, over a percentage point above the Fed's own longer-run projections of 2.6%. The Bank of England is also expected to anchor at an unprecedented 3.25 to 3.5% terminal rate. Even the historically conservative European Central Bank is no longer seen drifting back to its negative rate terra firma of the 2010s, with markets implying a new normal of 2 to 2.25%. What seismic forces are driving this revision? The answer lies in the twin shocks of artificial intelligence and fiscal profligacy reshaping the economic frontier. AI is poised to unleash waves of productivity gains across industries, boosting potential growth and inflation in ways not seen since the Internet revolution. The implications of machines augmenting human labor represent an epochal upheaval that economists are only beginning to factor into their models. If realized, the AI productivity miracle could upend the disinflationary trends that have ruled for 4 decades. Concurrently, the massive fiscal spending pipelines in the US and abroad are adding further inflationary kerosene. Between reconstructing domestic supply chains, financing climate transitions, bulking up defense, and absorbing costlier social safety nets for aging populations, governments are opening the taps. This tidal wave of demand-side stimulus could turbocharge growth while embedding stubbornly higher price pressures. Is the Great Moderation, that multi-decade period of low inflation and interest rates, now at its terminus? The markets seem to be forecasting its denouement. If they are correct, the economic rules that investment veterans internalized are about to be upended. Valuations must be reset across every asset class, from real estate to stocks to bonds, to account for this harsher new normal of costlier capital. Admittedly, the jury is still out on whether the productivity miracle or fiscal bacchanalia will truly materialize to such a transformative degree. The Fed itself remains publicly skeptical, deeming the recent inflation overshoot as yet another headfake in the disinflationary cycle. Its models continue expecting a gravity-like reversion toward that tantalizing, but now elusive, sub-3% policy rate equilibrium. But in the court of market opinion, the sentence is being handed down. The future paths of inflation, growth, and interest rates are being re-evaluated through a new, non-consensus lens. An era of wildly repressed financial conditions looks to be ending, potentially torching the portfolios forged in that ecclesiastical zeal. Whether investors' epical perspicacity proves prescient in the coming years will be economically momentous. For in divining a regime change toward structurally tighter financial conditions, they have proclaimed the dawning of a new, more constrained, economic epoch. Let us hope central banks' monetary monasteries are versatile enough to adjust their dated dogmas to this impending paradigm shift.